Ladies and gentlemen, welcome to another Independent View with Lobo Tiggre of the Independent Speculator. Our guest today is Ronald Stöferle, Managing Partner of Incrementum, and of course, author of the In Gold We Trust report, which is now in its 15th edition this year. So excited to have Ronnie back to talk to us about this. Before we go there, because I know a lot of people tune out at the end, all my YouTube friends tell me that I should tell everybody to click subscribe if you're watching this on YouTube. Click the alarm button so you're notified of new things. And please give us a like if you find value in the content and suggest it to others. So, housekeeping aside, Ronnie, welcome back. 15th In Gold We Trust report. What's new? What can you tell us this year, 15th year, that gold investors, silver investors, all investors should really think about?
Well, hi, Lobo. Thanks for having me again. It's quite a break, and every year we think, well, what should we write this year? And every year we try to write a little bit less, and every year we fail. But we didn't make a new all-time high in terms of the length, but we wrote almost 350 pages. So it is for every gold investor out there, for every mining and for every silver investor, it should be good reading material for the summer break. Well, the leitmotif of the report is the monetary climate change. So we're telling our audience that actually inflation is not transitory, that we are really seeing a paradigm shift in terms of this pendulum between inflation and deflation. And from our point of view, now inflationary forces are stronger than deflationary forces. So this is the main takeaway of the report, and we start, and we know this title and the cover is a bit provocative, but from our point of view nowadays, where everybody is talking about sustainability and SRI and ESG, I think it's also very important to stress the sustainability or the non-sustainability of our monetary system. So it is also I wouldn't say a rant, but it is also important for us to talk about those issues, yeah, and what it means for our society, for our economy, for our families, and I think that over the last year, many taboos were broken. I think the debt piles that were high already before, they are now significantly higher. We're seeing that this frugal Swabian housewife that we had, that tried to achieve balanced budgets. This is now, completely forgotten. So it's important to make a sober and solid case for gold. And I think we created quite an interesting report once again.
Let me jump in there before, because there's so much we could say, but let's focus in on some of the key things you just said, because I think it's really interesting that even Powell actually, not just now, but for some time, for some years, he's been saying that longer term, the United States fiscal situation is not sustainable. Longer term, he has said that you can't just keep piling up the debt, and the national debt can't just keep going up forever, and the deficits can't go up forever, that it must be addressed. But of course, that's not for today, right? That's a problem for another today. Now is an emergency. We have to have everything easy money. But even somebody like that admits that it's not sustainable. So, but we're in this emergency mode. So what's your answer to that? Like, there are people who will say, yes, Ronnie, you're right. You can't just spend forever, but right now we have this emergency situation. Are they wrong? I mean, there's the Delta variant. Is fiscal conservatism the right thing when we're in the midst of a pandemic?
Well, I think already before the pandemic, I didn't see too much fiscal conservatism. And now, of course, I think Russell Napier wrote in an interview recently that the income tax in the UK was implemented as an emergency measure in the year 1789 or something like that. So we know that those emergencies are always used to implement dramatic changes. Just think of the Patriot Act, for example, after the terror attacks. So I think, this is also one of the key takeaways of the report. I think that people are focusing still way too much on what the Federal Reserve is telling us and what the Federal Reserve is doing. I think we changed from an environment of monetary dominance to an environment of fiscal dominance. So I wouldn't say that the Fed is now irrelevant, but I think that now it's really fiscal policy that is ruling the market. So we should not forget that Wall Street is, has a much shorter time preference, while the Wall Street, while the White House probably thinks a little bit longer. And we know there's midterm elections coming closer, but I think that Joe Biden, he knows that he's a one-term president. He wants to go down in history books as a game changer or whatever. So I think it's really astounding how aggressive fiscal policy nowadays is, and I think this is one of the main drivers why inflation rates have risen so significantly, and why they just fail to come down. So from my point of view, fiscal policy, it is like, drinking 2 or 3 Red Bulls. You have a very immediate effect. Yeah, it kicks in pretty quickly, but then it also fades off very quickly. So I think the market is already telling us, well, we've got more fiscal stimulus. We are seeing a tremendous effect on the economy. We are seeing an effect on inflation rates because all those packages that are implemented, of course, they meet, let's say, a weak supply or disrupted supply and rising demand. But I think the market also knows that the effect will wear off pretty quickly. And actually, Lobo, I think that at the moment the market is already pricing in weaker economic growth. We're seeing it when it comes to the yield curve. We're seeing this bear flattener. So this is clearly telling us, well, the market is probably not seeing a recession yet. But I think the market is seeing weaker growth ahead. And I think it's also interesting, if you have a look at the silver gold ratio, for example, it peaked on February 25th. If you have a look at the copper gold ratio, it peaked end of April. If you have a look at the Aussie dollar versus the Swiss franc, it peaked on March 18th. So I think the market is now actually seeing, okay, the effect of the last couple of fiscal packages is kind of fading off. But of course, he needs to see more now. And I think now we are in this period in between. And I think at some point, equity markets will really start suffering. We're already seeing that the market is, we have seen new highs, but it's lacking breath. So the momentum of the general market is getting weaker. Fewer than 50% of the S&P 500 sectors have managed to make new highs. So this kind of confirms our view over the next couple of weeks that we'll see weaker economic growth, and at some point probably there will be another, probably even bigger fiscal package that will be implemented.
So what you're saying is that if I'm understanding you correctly, to summarize, what you're saying is that the weakness we're seeing now is in between, to switch metaphors on you, it's in between the hits for the junkie, the easy money junkies waiting for the next fiscal package. All right, well, 2 things. One, what if the next fiscal package doesn't come? Or what if there's so much political wrangling? There's the Democrats have this slender majority in the U.S., But inside, they have radicals there that want to hold out for an extreme agenda, and if they don't get it, they may vote no, and that could give the Republicans enough between them and that. What if there is no fiscal stimulus this year or next, and the wrangling just goes on in Washington?
Well, I previously said we should value the Federal Reserve less and look more closely on what the White House is doing or U.S. Fiscal policy is doing. However, I think that there's, for example, in the FOMC committee, there's one very, very important non-voting member that nobody's really talking about, and this is the S&P 500. And I think it's equally important for U.S. politics, for the Congress, for the White House. So if we see the market reacting to this in-between phase, then I think, at some point, even though many people think it's completely impossible, and I just tweeted out the numbers for the Bank of America fund manager survey, where only 3% of all fund managers, so they are professional investors, expect a bear market for the next year. So everybody's seeing a continuation of this bull market. But if it doesn't happen, and if we see the S&P going down 10, 15, 20%, I think the Federal Reserve and especially the White House will react very quickly. And I think if you study what's coming out of the Federal Reserve and think tanks and so on, I think it's clear that this wealth effect cannot be overvalued. I think nowadays it's really economic mainstream that the S&P has to go higher for consumer confidence staying high, for the general economic outlook to become positive. And of course, I mean, that's kind of it cannot be like a perpetuum mobile, and at some point it will break. But I think we are in the middle of this rat race, and therefore I think once equity markets go weaker, I think they will step in again. Of course, we're seeing this declining marginal utility of all measures, so we need more and more. But I think it would be naive to think in the next crisis they will say, well, we take an Austrian approach, laissez-faire, and let the markets correct everything.
To continue with my metaphor then, when the junkie goes into serious withdrawal, the pain will be too unbearable for the powers that be, and they will have to step in.
Exactly.
Right. Okay, but so there's another aspect to this, and it's goes back to where we started, the inflation scenario, how important that is, the climate change that you're seeing. There's some very smart people, and not just, let me rephrase that. Aside from the MMT crowd, which I'm not going to lump in the very smart people group, there's some very smart fiscal conservatives who are calling for deflation for some of the same reasons you're citing. There's these problems with the economy and more, and the aftershocks of shutting the engine of the world down last year have enduring effects. And there's still untold harm working its way through the global economy. And so there are people calling for recession or severe recession, and that is deflationary. Why should people, I have my own answer to this, but in your view, you're strongly in the inflation camp. How is it that you think inflation overcomes these deflationary forces, which seem they're real, they're out there?
Yes, absolutely. I mean, if there wouldn't be any market intervention, we would see deflation, and actually in a perhaps more Austrian world. And I'm not saying that because I am from Austria, but because I adhere to the Austrian School of Economics. I think deflation would be just normal, and actually before 1913 and especially before 1971. Almost 50% of all years have shown falling prices, so we are basically deflationary. But within our monetary system, and I think we talked about that in our previous discussion, deflation cannot be tolerated. Now, what is the market seeing at the moment? Yesterday, we saw very, very strong inflation numbers coming out, and the market reactions was basically that the curve was flattening. So it's interesting that the contracts, the longer term contracts, 2025 to 2026, those contracts actually rose in value. So traders at the moment expect rates to be lower, not higher during that period. So I think we have to ask ourselves the question, even though inflation has come in hot, the long end is up. So why is this happening? I think that at the moment, we're in this kind of weird spot where stronger than expected economic data causes market participants to bring forward rate hikes. And I think that the markets are kind of bullying the Fed, that this recent slightly hawkish shift is basically the path forward. And I think the market is also not believing this average inflation targeting policy that they introduced in August 2020. Now, everybody who believes that the Federal Reserve is not serious about inflation rates overshooting and the whole average inflation targeting policy should read the speech by New York Fed President John Williams. I think it's highly interesting. It's called The Theory of Inflation, of Average Inflation Targeting. And it's basically telling us, well, we are allowed now to let inflation rates massively overshooting. We are now really in control, or we think that we are in control. And as inflation rates were undershooting over the last couple of years, now we can inflation rates let overshoot over the next couple of years. So it is a highly, highly interesting speech that I think many people have not read yet. And I think the market is really, for the short term, it's seeing inflation, okay, is higher, but nobody believes that over longer term, inflation might become a concern.
Right. Did he define any numbers there? One of the concerns is like, because Powell says this all the time, but he says things, vague things like, moderately higher for, a sustained period of time, not how much higher, not how, and you look at inflation 4 or 5%. That doesn't seem like moderately higher than the 2% goal. That seems like a lot higher, and but nobody knows what will they do. So it's hard to blame investors for being skeptical, but also being uncertain where to go.
Absolutely, I agree. I think it's a I don't know, it's a scandal that there's no clarification about this average inflation targeting policy. And the ECB over here, they are also now moving into this direction. And I think, that's actually one of the most important prices of our economy. And there's only words, but no numbers to clarify how it will be interpreted. But Lobo, let me perhaps, because I gave you a very, very long answer or only 50% answer to your previous question. Now, why do we think that inflation will really, or let's say that inflationary forces are now being stronger than the deflationary forces? I mentioned average inflation targeting, which is a really big thing. I think it went largely unnoticed. It was implemented last August when everybody was kind of taking a breather from the whole COVID crisis. And I think market participants haven't really understood the consequence of this change yet. However, since they implemented average inflation targeting, inflation rates are up significantly. The second point is, from my point of view, velocity has been, collapsing over the last couple of months. But now, as the economies are opening up again, I think velocity will stabilize. Um, as of course there's the Delta variant and so on, but I think the worst is over now, and I think that people are gaining confidence again. They are planning, they're making investments, they start consuming and so on. So I think that velocity will be on the way upward.
Actually, let me jump in there. The velocity of money thing is important because it has backed off recently. And so people are using that as an argument against the inflation thing. I've also received criticism from Austrian economics types saying, the whole concept of velocity of money is baloney anyway. But in a funny money economy with fractional reserve banking and virtual money, we don't even have to print the stuff anymore. Sentiment does affect how many times those dollars go around. And so that velocity question is important. And you're saying it'll go back up again. It would be more comforting if we could say it is going back up again. What makes you so confident that velocity will kick up in the face of the headwinds that we're still dealing with in the economy?
Well, velocity is, I think the Austrian definition would be the demand to hold money. Which is very similar, but from my point of view, I wouldn't say that velocity is my main point or my main trigger for our inflation thesis. But basically, when rising confidence, and I'm seeing it, I'm talking to lots of business owners, I'm talking to investors, I'm talking to friends, and you can see, well, everybody says the worst is over now with the vaccinations kicking in. I think that most of the measures that are taken, they kind of make sense, and there might be a fourth wave, but I think the worst is clearly over. So I don't expect really brutal lockdowns like we had them previously. I hope so. But I think, talking to so many different people, it is clear that confidence is coming back, that people start consuming again, that they start investing again, and our economy is about confidence and how much people put faith and trust into the future. And I think this is clearly coming back now. So when this rising velocity or lower demand to hold money meets an enormous amount of liquidity that was created over the last couple of months, then it is of course a trigger for rising inflation. So actually, at the moment, I think that central bankers and politicians would actually have to become more hawkish and take liquidity out of the system. Of course, we know that they're, as always, way behind the curve and that they don't understand those time lags that are associated with those developments. So therefore, I think nobody will become hawkish and reduce liquidity in the system now.
I always wonder. Sorry, I got to jump in. I always wonder: do they really not understand, or do they feel like they have no choice? Like you can they really not know?
Well, Lobo, if I may ask you, has the Fed prevented any major market crash, and did they?
Right. Well, but that's an example of case in point. Like the Fed never predicts a recession, because if it did, it would cause the recession.
Exactly.
So they can't. But it's not that those guys and gals don't understand that there can be a recession. So anyway, it's a rhetorical point. Just basically what this tells us is that we can't listen to them because they can't tell us the truth. Even if they saw bad news coming, they couldn't tell us.
Yeah, I mean, if it's like if you go to the butcher, he probably won't recommend a vegetarian lifestyle. So they're just stuck in those institutions. And of course, I once read a really interesting article about the academic background of most of the economists sitting in central banks, and it's it's almost 100% equal. So they attended the same schools, they read the same books. So I wouldn't expect how would you say, any big discussion or divergence when it comes to those to these opinions. And I don't think that they would invent or invite an Austrian economist to work there.
Talk about an
So
echo chamber. Actually, you touched on something else, Ronnie, that I really wanted to ask you about because, I mean, many of people in my audience are in the U.S. or North America. I have people all around the world as well, but the bulk of them are over here, and we tend to be very U.S. centric. But also, we talk about the dollar and the Fed all the time, and it's not that the U.S. is the only country in the world, but the commodities that we care about, and gold and silver in particular, they're priced in dollars. So is oil. You know, these vital economic things are priced in dollars. So dollar policy really matters a lot. But the U.S. economy isn't the global economy, much less so in today's world. And I was wondering, you talked about how you have clients saying the worst is behind us, and you talk to people. I assume your client base is really much more global than mine. And I'm wondering if you could talk about your perspective on the other side of the pond there. You know, are we here in the U.S. too U.S. centric? And, you know, we talk about the Fed, but, you know, how important is the Fed's policy versus the ECB's policy and versus what the Chinese are doing? They just went easier in China as well. And all of these people are potential buyers for gold, not just Americans.
yeah, I mean, you know, when it comes to gold, we shouldn't forget that 2/3 of physical gold demand is now coming from emerging markets. So I think we're way too Western centric when it comes to gold, and I think, you know, if you go to Turkey, if you go to China, if you go to Vietnam, you can really see and feel and smell how important gold is for them. It's really a big difference. So yes, when it comes to gold, I think we should talk more about the demand coming from emerging markets. It has stabilized big time. I mean, last year, obviously, physical demand coming from China and from India was extremely weak. It was compensated or overcompensated by investment demand. For example, German retail demand was extremely high. We also saw in Austria or in Hungary, for example, we saw very high demand. The question is why, and I think, you know, who is leading the charts of the biggest hyperinflation in history? It is Hungary with the Hungarian pengő, and the Hungarian central bank just announced that they will make a big gold purchase. Austria and Germany experienced major hyperinflations. So I think it is a bit in our, let's say, in our monetary DNA to buy gold as some sort of monetary insurance. So there's clearly what we are seeing, very stable demand from the retail side, but also from institutional investors. If you have a look, for example, for us, ETF demand is a proxy for institutional gold demand, because as it is too risky, most fund managers are simply not allowed to buy any physical gold, so they have to buy gold ETFs or gold miners. When it comes to China, I think it's very interesting what you said, because actually China was basically doing the most hawkish, the most restrictive monetary policy over the last couple of months. Now we're seeing, if you have a look at for example, high yield spreads, if you have a look at credit growth and many other signs, or also the Shanghai Composite, which is not doing so well, we're seeing that China is struggling. And this is probably the main reason why the central bank is now becoming much more aggressive. But I think it's very interesting that there's now this kind of time lag between Chinese and Western central banking actions. When it comes to the ECB, I would say it is more of the same. It is to some degree, it's much more of the same. So they are also now moving to inflation targeting. I've got a sorry, that's where is it here? It says Madame Lagarde saying for your German audience, mein Gefühl sagt mir, dass wir uns weiter danach richten werden, günstige Finanzierungsbedingungen in unseren Volkswirtschaften zu bewahren. So she's saying, my feeling is telling me that we should continue to be more accommodative, more dovish, and to create a good environment for refinancing. So I think this is also a point that we're making in the Gold We Trust report. We're seeing a big move when it comes to the communication of central bankers. If you listen to Madame Lagarde, but also to Jay Powell, you sometimes think that it's like a Greenpeace activist or a social worker that is talking to us. And I don't want to criticize that, and it's their opinion, but I didn't really see that the mandates were changed before. So Madame Lagarde, for example, openly making a recommendation for the candidate of the Green Party in Germany. I think that is something that we wouldn't have seen for previous ECB representatives. So I think that central bankers now believe that they have to fight with climate change, that they have to deal with inequality and so on. Perhaps there's good intentions behind, but I just don't see that as the primary role of a central banker. But it's clearly going into this direction, and we're not seeing it only with central banking. We're seeing it, for example, when it comes to oil. We saw this enormous pressure on the boards of Chevron, of Royal Dutch, and so on. And I think we should not underestimate this political pressure that is now becoming bigger and bigger. So I didn't really answer your.
That's potentially a big can of worms, but it's okay because Madame Lagarde has a feeling that tells her that that everything's going to be fine. So let's not worry. Okay, all right. actually, Ronnie, you've been very generous with your time. I don't want to go on too long here, but I did want to ask you, 15th in Gold We Trust report. So you were doing this back when gold had its previous all-time high peak in 2011, and then kind of struggled for a while, 2012, and then fell off a cliff. I've had readers ask about it, and I'm sure many more think about it who don't. Like, how do we know that this time we haven't already seen the peak, that we saw the peak like in 2011, that we're struggling now, and that the next big move for gold isn't down? You were there, you saw what was going on there, here we are now. What's different between then and now, and what makes you bullish on gold now?
Well, I have to admit, in 2011, when we published the report back then, we were telling our readers, well, sentiment is already pretty bullish, so a correction could start, but we didn't see this major bear market coming. Yeah, I have to admit that, and now we have to learn from it. I think if we compare.
Sorry. Let me just jump in and say, me too. I remember thinking when 1,500 was a fantastic number in my mind, and when it went screaming up to 1,900, I remember saying to readers that we'll probably see some correction here. It's not a bad idea, but I did not expect a 5-year bear market. I hear you on that. Lessons definitely learned, and I'm much more cautious now about getting too enthusiastic. Sorry, I just had to echo what you're saying because I had the same experience. So please continue.
Thanks. So I think that we shouldn't forget that gold had a huge bull market that started basically in 2001, and we went from $200 up to 1,900. in this time frame. So it was a really big move. And I remember I attended a conference in London. I think it was in July or August, and then somebody, basically the moderator, announced that I just heard that the U.S. debt will be downgraded by S&P or Moody's, whatever. And actually there was standing ovations. Yeah, so people were really, also the gold community was extremely happy about that. But I think, in hindsight, the sentiment already was very, very positive. And over here in Austria, there were advertisements for, selling and buying gold everywhere. We saw really lots of crappy financings coming in. And we shouldn't forget, back then the GDX was trading at 60. Now it's trading at 34. It's basically the same with the gold bucks index, the HUY. Although, and I've tweeted this out a couple of days ago, now at the moment gold is actually trading at the very same levels like 1 year ago, so beginning of the summer. And back then, I think sentiment was already quite positive. Now, nobody really cares about gold, despite the fact that we are only, $200 basically below the all-time highs. Mining stocks are trading. I mean, last year was the most profitable year in the history of gold mining. This year will probably be even better. Mining stocks are trading at basically 50% of the valuation back from 2011, 2012. I think if we compare some numbers, 2011 versus now, 2011, I think it was end of August, gold was trading at 1900. Now it's trading at 1820. Back then, the monetary base in the US was 2.6 trillion. Now it's roughly 6 trillion. The M3 money supply back then was 9.5 trillion. Now it is roughly 20 trillion. US government debt back then was 14 trillion. Now it's 28 trillion. So I think, there's quite a lot of things. Also, the US dollar, back then it was trading at 778, the dollar index. Now it's trading at 92. So I think, there are very few similarities that would suggest that we are now on the verge of a brutal bear market over the next couple of years. So I think we should be very, very careful, and we should learn from our mistakes of our investment career. But I don't really see a pronounced bear market over the next couple of years. Why? I think one of the main reasons would be that we would have to see a spike in real rates. And with what I'm seeing on the inflation side, and what I'm seeing from Federal Reserve policy, and I expect, that's something that we could talk about for a while. At some point, I think that yield curve control will be implemented. So moving forward, we will see probably a decade or even more of negative real rates, of more financial repression, of more government intervention. And I just don't see that this could be a negative environment for gold. So I don't see it, but I could be wrong again. We could be wrong again. But at the moment, I think no.
Fair enough. All right. Well, I have 100 more questions, but I just have to go sideways on us here, because I know you're a Bitcoin fan, and it strikes me, we talked about this last time, but it strikes me as always curious that the author of the In Gold We Trust, this physical thing you can hold in your hand, is also a fan of this, vaporware that you can't touch, you can't see. Most of us can't even do the math that justifies it, so we just have faith and other smart people who say this is a really good thing and it's government proof and it has value, rather than get into a philosophical debate with you, what strikes me now as different from what we talked about before is that it seems like the regulators are really starting to pay more attention here. And I don't just mean China. You know, in the EU and in the US, they're talking more about the central banks crowding into the space, and they're worried more about criminals using it. And frankly, with these ransomware things stepping up, 70 million bucks this last one, that's the sort of thing that gets attention, I think, from on high. And it would be very easy to say that, you know, Bitcoin is just makes crime too easy. We have to make it illegal to own Bitcoin. And clearly that would impact the price. I mean, it may not make Bitcoin go away, but all the institutions that own it, that all have to dump. So talk to me about, you know, how is it that in Bitcoin you trust, Ronnie?
Well, you know, I've got sympathies for Bitcoin, but gold is still my love. And but I think, you know, Lobo, when we talk about narratives, I think when Bitcoin was created and when I first found out about it and bought some, which was in 2012, 2013, I think the people that I talked to, they really wanted to change our monetary system and to change the banking system, and those were very, you know, very, very interesting people that knew the Austrian School of Economics, that knew the flaws of our monetary system. And I also think that Satoshi Nakamoto, whoever it was, he created it as an answer or a solution to the great financial crisis. Then we had this narrative, well, it's only used for illegal activities, which is the US dollar as well, I would say. And now the new narrative is, well, that it's not green and you know, the energy usage and so on. But still, you know, Bitcoin was extremely overbought at 64,000. And in one of our pieces, we wrote that we are rebalancing in one of our funds out of Bitcoin, which is overbought, and into gold, which is oversold. And from our point of view, we use gold for stability and we use Bitcoin for convexity. I don't know if Bitcoin will be around in 5 or 10 years. That's also the reason why we've got a significantly lower allocation in our portfolios. But I think if it will be around in 5 or 10 years, then it will trade significantly higher. And I think actually that the track record of Bitcoin is pretty good, because the system works for more than 10 years, 24/7, without any flaws. Show me one, I don't know, e-banking application that works so well and so smoothly. We saw this correction that was from a, as I've said, extremely overbought level, and we saw so many really bad news. But still, I think it's trading significantly higher than 1 year ago. So therefore, I often say, well, you know, I don't understand this this criticism that is coming out from, especially from the gold side. I think we should embrace competition. We should talk about the advantages, but also the disadvantages of Bitcoin versus gold. But I don't think that Bitcoin is the enemy. I think that fiat currencies are basically the enemy, and that Bitcoin and gold, because they are not inflatable, because their stock to flow ratio is so high, because their inflation rate is roughly 1.5% every year, that those are reliable hedges against this very, very aggressive central bank and fiscal policy that we are seeing now. So therefore, you know, I think it's good that now this phase is over, where we saw this kind of George Soros reflexive move where it was only going up because it was going up. I think that many market participants, they burned their fingers. I hope they learned their lessons. But what I can see, Lobo, is that there's really lots of demand coming from the institutional camp, where especially the younger generation is regarding it as just a normal asset class. And of course, it is not something that we can touch, but actually, most of the things are virtual now. I mean, how often do you go to a real branch of your bank? Yeah, if everything is done on your cell phone, probably. I don't think that we use too much real letters anymore. We write emails. So I just don't understand this criticism. Okay, you cannot touch it. I just don't see it, because there are many things that are not physical and that you can touch, but still hold value. So long story short, gold for stability, Bitcoin for convexity. We use it. We use the enormous volatility of Bitcoin by writing options, which also works. We combine it in another fund where we write options on mining stocks, for example. So you can see volatility as your enemy, but you can also use it as your friend. And that's what we're doing. Yeah.
That's a classic Doug Casey actually saying, to make volatility your friend. And if you actually did do some rotating out of Bitcoin up at the 60,000 level, congratulations to you. Fantastic call.
Thanks.
That's terrific. And I appreciate your perspective. I will agree that as a free marketeer with an Austrian bent, let the market decide what should be money. I mean, there is no. It would be inconsistent philosophically, and I think empirically backwards, to try to impose the correct money on the market. Let the market decide. That said, I still like something that I can hold in my hand, and it still has value if the lights go off and there's no internet. But all right, thank you, my friend. That's a very fascinating conversation. I have a million more questions, but it's been a good run. So let me just let you have the last word. In gold we trust. Any final thoughts for 2021 here?
Well, everything that we think is important. We try to write it down. I think it's even for people that think they know everything about gold. There should be some new, very interesting facts and ideas in this report. My wife always tells me for that it's cheaper to write this report for me than going to the shrink, because there's so much stuff in my head, from conversations that I have, from books and newsletters that I consume. So once a year we're putting out this massive report, and I think it is really it is a bit of a distillery where all the thoughts and ideas are put into one big report. And we're getting tremendous feedback from all over the globe. So it's really great that people like it, people love it, they appreciate the information, and we're already working on the 2022 report.
Well, thank you very much. And actually, sincerely, thank you. As a consumer of your report, I particularly like the charts. I can't say I'm going to read 350 pages, Ronnie, much as I love your work. but to flip through and look at really eye-opening charts, and see the changes from year to year, I find that really valuable. So keep up the great work. Thank you so much for doing it, and have a great day.
Thank you very much. It's been a pleasure. Take care, my friend. Bye-bye.
Thank you for watching this edition of In the Pit with Lobo Tiggre. If you enjoyed or found value in what you just saw, and you're watching this on any sort of social media, please do hit the like button and the share link. Send this on to anybody you think might be interested. That helps us out a lot. If you're watching this on YouTube, please do hit the subscribe button as well. The number of subscribers helps us get more valuable content to you as well. On the subject of subscribing, I'll quickly say that if you're not a subscriber to our free weekly Speculators Digest, I encourage you to sign up. I promise if you do, we will not send you a flood of daily advertisements. You get one free weekly digest with original research not published anywhere else. Check it out at independentspeculator.com. Thank you and have a great day.